Is this the end of fiat money? Most business leaders believe their cash holdings represent stable value, that central banks have everything under control, that the price of silver is just another commodity moving up and down. They're wrong. Right now, in warehouses across Shanghai, Dubai, and London, physical silver is trading at prices that make no sense compared to what you see on financial screens. The gap is widening, delivery windows are extending, and institutional players are quietly moving in ways they haven't since 2008. What's happening isn't a rally, it's a fracture, and the part that should concern every business owner watching this is what that fracture is revealing about the money sitting in your corporate accounts right now. Welcome to Silver Radar. If you've built something real in your life, a business, a legacy, assets that took decades to accumulate, then you already understand that protecting what you've built matters more than chasing what you haven't. This channel exists for people who think like that. We don't do hype, we don't do entertainment. We analyze what is actually happening in precious metals markets and what it means for people who make real decisions with real capital. If that sounds like something worth your time, go ahead and subscribe now. You have likely sat through enough boardroom presentations to know when someone is wasting your time and when they're not. Judge for yourself, but do it as a subscriber so you don't miss what's coming. And comment below, let us know where you're watching from. Singapore, Texas, London, Mumbai. This community spans continents, and it's valuable to see who else is paying attention while the crowd is still distracted. Now, let's get into what's actually happening. Most business owners operate under a comfortable assumption. They believe the money in their corporate accounts represents actual value, that the dollars, euros, or pounds sitting in their treasury are backed by something real, something solid. They trust that when they look at their balance sheets, those numbers mean what they've always meant. But here's what nobody wants to say out loud in boardrooms or financial planning meetings. That assumption is built on nothing but collective agreement. Fiat currency, the paper money every business in the world uses, doesn't represent gold anymore. It doesn't represent silver. It doesn't represent anything except a promise from a government that is currently drowning in debt it can never mathematically repay. And when enough people stop believing in that promise, when confidence cracks, things that looked boring and outdated, like silver, suddenly become the most important assets in the room. Right now, something is happening with silver that most business leaders aren't paying attention to. They see a price chart moving up, maybe moving down, and they think it's just another commodity doing what commodities do. They're missing the signal. Silver isn't behaving like a normal commodity right now. It's behaving like a monetary asset that's waking up from a decades-long suppression. The price recently exploded past 117 per ounce before pulling back to around 110 in dollars. That kind of violent movement, that kind of whipsaw action, is not normal market behavior. It's a warning sign. But the price movement itself isn't even the most important part. What matters more is what's happening underneath the surface in the mechanics of how silver actually trades and how it's delivered. See, when most people look at silver prices, they're looking at something called the spot price. That's the price you see on financial websites and trading platforms. It's the price that futures contracts trade at on exchanges like the COMEX in New York. But here's the problem. That spot price represents paper contracts, promises to deliver silver at some point in the future. It doesn't necessarily represent the price of actual physical silver that you can hold in your hand. And right now, those two prices, paper silver and physical silver, are starting to disconnect. When a business owner or a serious investor tries to actually buy physical silver bars or coins, they're discovering something disturbing. The premiums, the extra cost above spot price, are significantly higher than they used to be. In some markets, particularly in Asia and the Middle East, physical silver is trading at prices that make the COMEX spot price look completely detached from reality. Why does this matter? Because when paper prices and physical prices diverge, it means one of two things is happening. Either the paper market is artificially suppressing the real price, or the physical market is experiencing a shortage that the paper market hasn't acknowledged yet. Both scenarios point to the same conclusion. The system isn't working the way it's supposed to. Futures markets exist for a specific purpose. They're supposed to facilitate price discovery. They're supposed to allow producers and consumers to hedge risk. And yes, they're supposed to allow for physical delivery when contracts expire. But when delivery becomes difficult, when premiums explode, when the spread between paper and physical widens dramatically, the market is sending a message. It's saying that confidence in the paper mechanism is breaking down. And this isn't just theory. There's hard evidence showing up in dealer behavior, in delivery data from the COMEX, and in the actions of institutional players who manage billions in assets. Dealers are reporting longer wait times for physical delivery. Margins, the amount of capital required to hold futures positions, have been increased multiple times, which is what exchanges do when they're worried about volatility or delivery risk. Meanwhile, central banks in countries like China have been quietly accumulating precious metals, not paper contracts, physical metal. Why would institutions that manage national reserves be buying physical silver and gold if fiat currency systems were as stable as everyone pretends they are? They wouldn't. They're preparing for something. They see the same mathematical impossibilities that any serious analyst can see when they look at global debt levels, deficit spending, and central bank balance sheets. Here's the reality that most business owners haven't confronted yet. The monetary system they operate within is not the same system their parents or grandparents used. It's not backed by anything tangible. It's backed by confidence and the promise of future tax revenue from economies that are already overleveraged. And when confidence starts to crack, which is what's happening right now in precious metals markets, assets that seemed old-fashioned and irrelevant suddenly become critical. Silver is not just moving because traders are speculating. It's moving because the underlying confidence in paper currency systems is fracturing, and the fracture is widening. What comes next isn't about predicting an exact price target or timing a perfect trade. What comes next is understanding what this breakdown reveals about the financial infrastructure every business depends on. Because if the delivery mechanisms are failing, if paper and physical markets are decoupling, if institutional players are positioning in hard assets while retail investors chase paper contracts, then the question every business owner should be asking isn't whether silver is going up or down. The question is, what does this breakdown mean for the cash I'm holding right now? There's a moment in every market crisis when the polite language stops working, when the carefully worded statements from exchanges and clearinghouses can't hide what's actually happening anymore, when the gap between what is supposed to happen and what is really happening becomes too obvious to ignore. Silver is entering that moment right now. And the people who understand delivery mechanics, the unglamorous technical side of commodity markets that nobody talks about at dinner parties, are watching something they haven't seen in decades. They're watching the system struggle to deliver physical metal against paper promises. Let's be clear about what a futures contract actually is. When someone buys a silver futures contract on the COMEX, they're entering into an agreement. That agreement says they will either take delivery of physical silver at a specific date, or they'll roll the contract forward, or they'll close it out before expiration. Most contracts never go to delivery. Most are closed out. That's normal. That's how the system is designed. But here's what's not normal. When the percentage of contracts demanding actual delivery starts rising, and when the exchange responds by making it more expensive to hold those positions, that's a red flag. COMEX has raised margin requirements on silver contracts multiple times in recent months. Margin requirements are the amount of capital a trader must put up to hold a position. When an exchange raises margins, they're essentially saying, this market is getting too volatile or too risky or too difficult to manage, so we need more collateral from anyone playing in it. Why would they need to do that if everything was functioning smoothly? They wouldn't. They raise margins when they're worried, when they see stress in the system. When delivery demand is creating problems they didn't anticipate. And it's not just the COMEX showing stress. Look at what's happening with dealer premiums around the world. A dealer premium is the markup that physical silver sellers charge above the spot price. In normal markets, these premiums are relatively stable and predictable. A few percentage points, maybe a bit more for coins versus bars, nothing dramatic. But right now, dealers in certain markets are charging premiums that would have been unthinkable 2 years ago. In Asia, particularly in markets like Shanghai and Dubai, the premiums on physical silver have exploded. We're not talking about small increases. We're talking about double-digit percentage markups over spot price. In some cases, physical silver is changing hands at prices $20, $30, even $40 above what the COMEX says silver is worth. That's not a premium. That's a completely different market. Think about what that means from a business perspective. If you're a manufacturer who needs physical silver for industrial production, and the COMEX says silver is trading at $110, but when you actually try to source the metal, you're being quoted $140 or $150. Which price is real? The answer is obvious. The real price is whatever you actually have to pay to get the metal delivered to your facility. The paper price becomes irrelevant. The paper price becomes irrelevant. And this divergence isn't happening in a vacuum. It is happening at the exact same time that China, the world's largest producer and consumer of silver, has implemented export restrictions on certain strategic metals. China doesn't make moves like that randomly. They don't restrict exports of critical industrial materials because they're trying to be difficult. They do it because they're securing domestic supply for their own strategic purposes. When a major producing nation starts limiting exports, it sends a signal to every other country and every major institution. Supplies are tightening, and if you need this material, you better secure it now while you still can. And that's exactly what institutional players are doing. While retail investors are trading paper contracts on their brokerage apps, large institutions, sovereign wealth funds, family offices, corporate treasuries, are quietly accumulating physical metal. They're not buying silver because they think it's going to have a nice little rally. They're buying it because they understand something that most business owners haven't figured out yet. When monetary systems come under stress, the difference between paper claims and physical assets becomes the difference between wealth preservation and wealth destruction. During the 2008 financial crisis, something similar happened in the gold market. Paper gold prices crashed along with everything else. But if you tried to actually buy physical gold coins or bars during the peak of the panic, you couldn't find them. Dealers were sold out. Premiums went through the roof. Delivery times stretched from days to weeks to months. The paper price said one thing. The physical market said something completely different. That's what a crisis in confidence looks like. That's what happens when people stop trusting the paper system and start demanding the real thing. And we're seeing the early stages of that same dynamic in silver right now. The Shanghai Gold Exchange, which also trades silver, consistently shows prices above COMEX. That's arbitrage opportunity. In theory, traders should be able to buy silver on COMEX, ship it to Shanghai, and sell it for a profit. But that arbitrage isn't closing. The gap persists. Why? Because moving physical metal internationally isn't as simple as clicking a button on a trading screen. There are logistics, there are export restrictions, there are delivery timelines, there are costs that don't show up on a price chart. And when those practical realities start dominating price action, it means the paper market has lost control. Here's what business decision makers need to understand. The institutions that manage serious capital, the kind of capital that represents generational wealth or national reserves, do and operate the way retail traders do. They don't chase price momentum. They don't trade based on technical chart patterns. They position based on structural analysis. They ask, what is mathematically sustainable and what isn't? And when they look at debt levels, deficit spending, and central bank policy, they reach the same conclusion. Fiat currency systems are running on borrowed time, so they buy hard assets, quietly, strategically. While paper prices are still suppressed and while physical supply is still available, by the time the crowd figures out what's happening, the metal will already be in institutional vaults. The delivery system will be strained beyond capacity, and the gap between paper promises and physical reality will be too wide to ignore. That moment is approaching faster than most people realize. Wall Street has a strange relationship with chaos. They measure it, they quantify it, they build entire mathematical models around it, and then they pretend it's something they can control. Volatility, the speed and magnitude of price swings, gets treated like background noise in most financial conversations, something to be managed, something to be hedged away, a technical nuisance that sophisticated traders handle with options and derivatives. But here's what the textbooks and the risk management seminars never quite explain properly. Volatility isn't just statistical noise, it's information screaming at you. When an asset starts experiencing extreme volatility, when prices whipsaw violently, when daily moves start exceeding what probability models say should happen once in a century, that asset is broadcasting a message. It's saying the market participants fundamentally disagree about what this is worth. Not just disagree a little, disagree violently. Disagree to the point where consensus has completely broken down. And that's exactly what's happening with silver right now. The recent price action, rocketing above $117, then crashing back toward $110, then bouncing again, isn't normal commodity behavior. This isn't corn or wheat or copper having a typical supply and demand adjustment. This is an asset class that the financial system has treated as a relic for decades, suddenly coming back to life with enough force to break probability models. Standard deviation is the mathematical term that measures how far prices are moving from their average. In a normal market, about 68% of price moves fall within one standard deviation. About 95% fall within two standard deviations. When you start seeing 3, 4, 5 standard deviation moves happening regularly, when price action that's supposed to occur once every few thousand years starts happening every few weeks, you're not looking at a normal market anymore. You're looking at a regime change. Something fundamental has shifted. The old assumptions don't hold. The models built on historical data are worthless because the current environment doesn't resemble the past. And yet, most business owners and investors keep approaching silver and precious metals broadly with the same framework they use for stocks or real estate. They ask, is this a good investment? What's my return going to be? When should I sell? Those are the wrong questions. Because silver isn't functioning as an investment right now. It's functioning as insurance against a specific type of risk that most corporate balance sheets completely ignore: monetary system risk. Think about how businesses typically manage risk. They buy insurance for their buildings in case of fire. They buy liability coverage in case of lawsuits. They maintain cash reserves in case revenue drops. All of that makes sense. But what insurance do they have against the possibility that the currency those cash reserves are denominated in loses significant purchasing power? What protection exists if confidence in fiat money systems deteriorates? For most businesses, the answer is none. They're fully exposed to monetary risk, and they don't even categorize it as a risk factor. Professional risk managers at the institutional level think differently. They don't look at precious metals as a way to make money. They look at them as a way to not lose money during specific types of crises, currency crises, sovereign debt crises, banking system failures, the kind of events that don't happen often. But when they do happen, they destroy unprepared institutions completely. And the thing about insurance is this: you don't buy it because you're certain the disaster is coming next week. You buy it because if the disaster does come and you're not prepared, the cost is catastrophic. That's the proper framework for understanding precious metals allocation in a business context. It's not about timing a perfect entry point. It's not about catching the exact bottom or selling the exact top. It's about answering a strategic question. What percentage of enterprise liquidity should be held in assets that cannot be debased by central bank policy? That question has a different answer for every business, depending on their specific situation. A company with 3 months of operating expenses in cash has different needs than one with 3 years. A business operating internationally in multiple currencies faces different monetary risks than one operating purely domestically. But the question itself is what matters, because most business owners never ask it at all. They operate under the unconscious assumption that the monetary system is stable, that their cash will retain its value, that the rules of the game won't change. That assumption worked fine for the past 40 years. It may not work for the next 40. And here's where volatility connects back to positioning strategy. Institutional players, the ones managing billions in assets, the ones with entire departments dedicated to risk analysis, they use volatility windows strategically. When silver experiences extreme price swings, when panic selling drives prices temporarily lower, when margin calls force levered traders to liquidate positions, that's when institutions step in. Not emotionally, not reactively, systematically. They're not trying to trade the volatility. They're using the volatility created by others to acquire positions at advantageous prices. Meanwhile, retail investors and many business owners who should know better do the exact opposite. They wait for stability. They wait for certainty. They wait for confirmation that the trend is safe and established. And by the time they get that confirmation, the institutional buyers have already positioned. The easy entry points are gone. The risk-reward ratio has shifted. This is the critical mistake that turns a strategically sound decision into a losing trade. Buying precious metals at $150 silver because everyone knows it's going higher is speculation. Buying precious metals at 110 silver as a systematic allocation to hedge monetary system risk, that's risk management. The difference isn't just the price, it's the reasoning, it's the framework. It's whether the decision is driven by fear of missing out or by a coherent analysis of structural risks. Business leaders who've built real enterprises understand this instinctively in other areas. They know that the best deals get done when everyone else is scared. They know that buying distressed assets during a panic requires courage, but it's often the highest return strategy. The same principle applies to monetary hedging. The time to establish positions in hard assets is not when the financial media is screaming about currency collapse and silver is already at $200. It's now, when there's still doubt, when half the commentators are still saying everything is fine, when volatility creates temporary price dislocations that won't last. Because once the crowd figures out what's happening, once the confidence crisis becomes undeniable, once delivery problems become mainstream news instead of niche concerns, the window closes, and businesses that waited for certainty will be forced to make decisions under pressure at worse prices with fewer options. That's not strategic positioning, that's panic. The entire point of hedging monetary risk is to do it before the risk becomes obvious to everyone else. There's a number that almost nobody wants to talk about in polite economic conversation. It's not hidden, it's publicly available. Any business owner can look it up in about 30 seconds. But acknowledging what it means, accepting the implications, that's a different matter entirely. Global sovereign debt is now over 100 trillion. Not million, not billion, trillion. And that's just the official number, the number that governments report. It does not include unfunded liabilities like pension obligations and healthcare promises that are coming due over the next few decades. When you add those in, the real number is several multiples higher. Here's the uncomfortable question that follows. How does that debt ever get repaid? Not in theory. Not in some fantasy scenario where economies grow at 5% forever and governments suddenly discover fiscal discipline. In reality, with actual tax revenue, with real economic output. The answer is simple. It doesn't. It can't. The mathematics don't work. They haven't worked for years. And every serious economist who's willing to be honest about it knows this. So if the debt can't be repaid, what happens instead? There are only 3 options. Option 1, default. Governments declare bankruptcy. They refuse to pay creditors. Bondholders take massive losses. The financial system collapses. Politically, that's unacceptable. Economically, it's catastrophic. So option 1 is off the table for any major economy. Option 2, austerity. Governments cut spending dramatically, they slash budgets, they reduce entitlements, they raise taxes to levels that strangle economic activity. Again, politically toxic. No elected government survives implementing real austerity. So option 2 doesn't happen either, except in small countries with no other choice. That leaves option 3, the only option that's politically feasible and economically possible. Debasement, print more currency, inflate the debt away, make the numbers easier to manage by making the currency worth less. It's not a conspiracy. It's not a secret plan. It's just basic political economy. When governments have too much debt and can't cut spending and won't default, they print. Every fiat currency system in history has eventually arrived at this point. The Roman denarius, the German papier mark, the Zimbabwean dollar. The list goes on. And the US dollar, the euro, the yen, the pound, they're all walking the same path, just at different speeds. The Federal Reserve's balance sheet, the amount of assets they hold, which represents the amount of currency they have created, went from under $1 trillion before 2008 to nearly $9 trillion at its peak. That's not economic growth, that's currency creation. That's debasement by another name. And here's the part that should terrify anyone holding significant cash positions. That expansion can't reverse without triggering a deflationary collapse that would make 2008 look like a minor correction. So it won't reverse, not really, not permanently. Central banks are trapped. They expanded their balance sheets to rescue the system during the 2008 crisis. Then they expanded again during the COVID crisis. And every time they try to shrink those balance sheets, every time they attempted quantitative tightening, the markets start breaking and they have to reverse course. This is what a structural endgame looks like, not a dramatic overnight collapse, not hyperinflation next Tuesday, but a slow, grinding erosion of purchasing power that most people don't notice month to month, but that devastates wealth over decades. Except it's not always slow. Sometimes the erosion accelerates. Sometimes confidence breaks suddenly. Sometimes a currency that looked stable for years loses 20, 30, 40% of its purchasing power in a very short window. Turkey, Argentina, Lebanon, Venezuela. These aren't ancient history. These are current examples of what happens when confidence in a currency system fails. And the mechanism is always the same. Too much debt, too much printing, too many promises that can't be kept. And then a moment when the population realizes the money they're holding is not going to hold its value. That's when precious metals go from being boring relics to being essential survival tools. Because when a currency loses 20% of its value in 6 months, the businesses that had 30% of their liquid assets in gold or silver survive. The ones that were 100% in cash don't. This is not theoretical. This is pattern recognition from hundreds of historical examples. And here's what business owners need to understand about the phrase end of fiat money. It doesn't mean money disappears. It doesn't mean we go back to trading chickens and wheat. It means the current system, where currency is backed by nothing except government promises and central bank policy, reaches a point where confidence becomes unsustainable. What comes after that varies. Sometimes it's a currency reset. Sometimes it's a new currency altogether. Sometimes it's a regional or global digital system backed by a basket of commodities. But the transition period, the gap between the old system losing credibility and the new system establishing itself, that's when wealth gets destroyed or preserved based on what assets you're holding. Paper currency loses value during transitions. Bonds lose value. Anything denominated in the failing currency gets crushed. Hard assets, real estate, productive businesses, precious metals, those are what preserve wealth across monetary system changes. And of all the hard assets available, silver has unique characteristics that make it particularly relevant right now. It's monetary. It has thousands of years of history as money. It's recognized globally. It's portable. It's divisible. But it's also industrial. It's used in solar panels, electronics, medical equipment, batteries. It has tangible utility beyond just being a store of value. That combination, monetary properties plus industrial demand, creates a situation where silver benefits from multiple trends simultaneously. If currency debasement accelerates, silver benefits as a monetary hedge. If the global economy continues transitioning toward green energy and advanced technology, silver benefits from industrial demand. And if both happen at the same time, which is exactly what's unfolding right now, silver becomes one of the most strategically important materials on Earth. That's why central banks in countries like China are accumulating precious metals. That's why institutional players are positioning in physical assets. That's why delivery problems are emerging in futures markets. Because the people who manage generational wealth and national reserves understand what's coming. They can see the debt mathematics. They can see the political impossibilities. They can see that the current monetary system is running on borrowed time. So they're preparing, not predicting. Preparing. There's a massive difference. Predicting means you think you know exactly when the crisis hits and exactly how it unfolds. Preparing means you acknowledge the structural problems, You recognize the historical patterns, and you position accordingly regardless of exact timing. Because here's the final truth that every business owner needs to internalize. The cost of being wrong about monetary system stability is catastrophic. If you prepare for a currency crisis and it doesn't happen for another 20 years, you've held some assets that maybe didn't appreciate as much as stocks. That's the downside, mild underperformance. But if you don't prepare and the crisis does happen, if confidence breaks and your cash positions lose half their purchasing power in 18 months, if you're scrambling to convert devaluing currency into hard assets while everyone else is doing the same thing, that's business ending. That's wealth destroying. That's generational damage. The asymmetry is obvious, so the question isn't whether to allocate some portion of enterprise liquidity to precious metals. The question is, what percentage makes sense for your specific situation? And the critical mistake, the error that turns a sound strategic decision into a losing position, is waiting too long to answer that question. Because by the time monetary crisis becomes mainstream consensus, by the time financial news networks are running daily segments on currency debasement, by the time even the people who laughed at gold and silver believers are scrambling to buy, the window is closed. Premiums will be massive. Delivery will be delayed or impossible. Prices will reflect panic rather than rational valuation. Strategic positioning happens before the crowd arrives. It happens now. While there's still doubt, while half the experts are still saying everything is fine, that's when preparation costs the least and provides the most protection. This is not financial advice. This is structural economic analysis for decision makers who understand that the businesses which survive monetary transitions are the ones that prepared before the transition became obvious. The system is fracturing. The delivery mechanisms are strained. The confidence is eroding. And silver, both as a monetary hedge and an industrial metal, is broadcasting that fracture louder than almost any other asset. The question is whether business leaders are listening.